Last episode, every strategy we touched got hurt by the 4 crush. Today we walk around to the other side of the table and sit in the seat where that exact same crush pays you. I'm Onyx.
And I'm Nova. So last time we were buying lottery tickets. Today we're the people selling them?
That's a surprisingly good way to put it. Today we sell premium. Welcome back to Options Decoded. Same stock, same Micron earnings night, opposite bet. First, a quick and honest word. Everything you're about to hear is really just the two of us thinking out loud, personal market commentary, made for learning and for fun. It isn't investment advice, and it isn't a recommendation.
And when we talk about a specific company, it's only ever to make a bigger idea click. Never a nudge to buy or to sell. So take it as a starting point for your own curiosity. Do your own research and make the call that's right for you. So flip everything from last time?
Flip all of it. You collect money up front instead of paying. You're short volatility, short vega, so the 4 crush is now your tailwind. And you win if the stock moves less than the implied 13%. The headline trade-off also flips, and it's the big one. These tend to have a high win rate, but you often risk more than you can make. We'll stare right at that.
Walk me through collecting money. That feels backwards.
It feels backwards until it clicks. In a credit spread, you sell one option and buy a cheaper, further out one for protection. You collect more than you pay, so cash lands in your account today. That's your max gain. You keep it as long as the stock stays away from the option you sold. The protective long option you bought caps the damage if you're wrong, so your risk is defined, known and capped. Selling, but with a seatbelt. Concrete example. A bull put spread. You sell the 940 put and buy the 840 put. You collect about $14, $1,400, and that's the most you can make. Your bet is simply, Micron stays above 940. If it does, both puts expire worthless, and you keep the credit.
And the diagram?
A flat plateau of profit across the whole upper range. Your max gain. Then it slopes down into a loss if the stock falls through your strikes, flattening at a defined max loss of about 8,600. Break even down around 926. Win probability is high, roughly 4 times out of 5, because you only need it to not crash.
Let me guess the mirror before you say it. Bearish version. Sell a call spread above the price?
You're hired. The bear call spread. Sell the 1140 call, buy the 1240 call. Collect about $15, $15.20. Your bet, Micron stays below 1140. Same shape, flipped. A plateau of profit on the downside, sloping into a capped loss if it rallies hard. Break even around 1155, win rate again about 80%.
80% win rate sounds amazing. What's the catch? There's always a catch.
Here's the catch, and please don't skip past it. On that bear call, you collected about $1,500, but your max loss is about $8,500. You are risking $8,500 to make $1,500. So yes, you win often, but when you lose much bigger than any single win.
So a high win rate can still be a losing strategy if I'm careless.
Exactly that. Critics call it picking up pennies in front of a steamroller. The defenders say, the premium is overpriced before earnings, the probabilities really are on your side, and if you size it sanely and respect that defined max loss, it's a real edge. Both are right. The number that keeps you safe is the max loss, and you must be at peace with paying it.
Why do this into earnings specifically with that risk?
Because of the crush. Remember, for inflates the premium of every option going into the print, sometimes wildly. As a seller, you're selling that inflated, overpriced fear. Then the news drops, uncertainty vanishes, for collapses overnight, and the options you sold deflate in your favor, often regardless of small moves in the stock. You sold something expensive, and it got cheap by morning. That's the seller's edge in 3 sentences. Now the signature short vol earnings trade, the iron condor. It's just both spreads we built, stacked together. A bull put below the price and a bear call above it. You collect from both, about $29, $2,900, and you win if the stock simply stays in a range, roughly 911 to 1169.
So this is the pure, I bet tonight is boring trade.
The purest one there is. You're not picking a direction at all. You're betting the move is smaller than the crowd fears. The diagram is a tabletop, a wide, flat plateau of profit across the whole middle range, dropping off into defined losses only at the far edges. Max gain 2,900, max loss about 7,100, win rate around 2 and 3.
And it's the same risk shape. Risk more than I can make?
Same shape, and explicitly so. You're directly betting against the big surprise. Most earnings nights, the move is smaller than the panicky implied number, and the condor quietly wins. But on the blowout night, the 13% becomes 20 night. That's exactly when it hits its max loss. Comfortable most of the time, brutal precisely when everyone's surprised. Know which night you're afraid of.
Everything so far is stays in a range, or moves big. What if I think I know roughly where it lands?
Then you've earned the most elegant tool in the box, the butterfly. You buy one option, sell two at your target strike, and buy one further out. The result is a sharp tent that peaks right at your target, cheap to put on, defined risk, and wildly convex. If the stock pins your number, the payoff is huge relative to the tiny cost. And here's a refined version, just one illustrative targeted play among many, not a recommendation. The broken wing butterfly. You make the two wings unequal widths. In a put version targeting, say, around 940, it costs about $30, and if the stock lands near that target, the payoff is roughly 8,000, against a max loss of about 3,000. The broken wing can even make one side nearly risk-free.
What does the diagram look like? That sounds lopsided.
It is lopsided on purpose. A tall, lopsided tent that spikes at the target and goes flat. Not loss, just flat, past one wing. It's the sniper rifle of options, a cheap, precise, defined risk way to say, I think it lands here. Beautiful when you're right about the spot, quietly expires near zero when you're not.
So why doesn't everyone just snipe?
Because you have to be right about where, not just which way, and where, on an earnings night, is genuinely hard. So these have a lower hit rate. The appeal is the math, tiny cost, defined risk, convex payoff. You can be wrong several times cheaply, and still come out ahead if you nail it once. It's a different kind of bet, precision over probability. Let's grade the bucket. The credit spreads and the iron condor. Sell premium, short vega, crushes the tailwind, high win rate, but risk that's bigger than the reward, so discipline and the max loss number are everything. The butterflies, targeted, cheap, defined, convex, lower win rate, but a small, precise bet with an outsized payoff if you pin the spot.
So last episode was big payoff low odds, and today is high odds but capped, plus the sniper plays.
That's the whole landscape in one breath. And notice, nobody's right in the abstract. Each one just expresses a different view of the same night.
Reality check time.
Please. Selling premium feels great, money up front, you win most nights, and that's exactly what makes it sneaky. The risk bigger than reward profile means one bad surprise can erase many wins, and the short legs carry assignment risk, where you can be handed actual stock. These are defined risk if you built them right, but you must respect the max loss as a real number you might pay. Education only, never a go sell premium into earnings.
Okay, selling the fear. Collect the inflated premium, let the crush work for me, win if it's quiet, but always know the bigger number on the downside. And the butterflies for when I think I know the exact spot.
Nailed it! So far we've bet on the move and sold the move. Next episode is the practical one. What if you already own the stock and just want to survive the night? Plus the one strategy that's flat out wrong for earnings, our cautionary counterexample, and a single cheat sheet that ties this entire series together.
Owning it and what not to do. Come back for episode 4. And then the finale, where Micron's actual move crowns a winner. Thanks for learning with us.
Okay, that's our episode. The honest goal here is simple. Hold a few ideas about the world, and keep checking whether they're still true.
Together, out loud, a little at a time. If you spot where we've got it wrong, please tell us. That's how this gets better. See you next time.